I'm going to go over the 4-step process that I look for every single day before placing a trade that has made me over 6 figures in funding in 2024. If you guys learned anything from this video, make sure you guys give this video a thumbs up and watch until the end. Before we get into the video, make sure you guys are following me on Instagram. This is where you can find me. So the first thing that we're going to go over in this 4-step process is bias/narrative. You have to understand that bias is simply a mix of two things. Bias is a mix of structure plus order flow, meaning that if we're going higher and higher and higher and higher and higher, right? Let's say we're here, right? We're anticipating a pullback. We're anticipating a pullback in price action. Oh, wait. There's a bullish fair value gap or a bullish order block here, right? So there's some type of PD array. There's some type of support level here. It'd be reasonable for us to anticipate a pullback into this level to then see a continuation higher. That would be bias, right? Or the opposite could be said. We have been going lower, lower, so structure is bearish. Structure is bearish. We're anticipating a pullback here. Bearish area of resistance here, either that be a order block, a breaker block, fair value gap, whatever you guys use and whatever you guys can see properly. You know, I see fair value gaps the best. Some traders see order blocks the best. Some traders love breakers. Me personally, I don't trade breakers often, but I know a lot of traders who make a lot of money trading breakers, and that's what they like to see best. I like to see fair value gaps best. So I'm seeing a bearish fair value gap here. I'm anticipating a pullback to then see a continuation lower. So that would essentially be my bias for the day. It's also important to understand where you are in structure. So if we have been going higher and I'm anticipating a pullback, you know, one of two things can happen. You can either take the long from this pullback in this support area as a trade here, right? Or I could take a short coming into the market open into this area here for like a 2 to 1 R or maybe a 1 to 1 R as a counter trend trade. You know, when choosing bias, there's two things. You're either taking a trend trade or a counter trend trade. So understand where you are in the market and form an opinion on what you believe is to happen. That is bias. Typically, you'd want to trade with the trend, so the best opportunities that you will get inside of the market is with the trend, meaning wait for the pullback, anticipating the pullback, and then seeing that continuation higher. This is a rudimentary example of bias and narrative, but this is the fundamentals that go in it. Understanding where am I in market structure. Is this going to be a trend trade, which I'm looking to get a 3R on, or is this going to be a counter trend trade, which I'm going to look for more of a scalp play opportunity? Because you can make money trading both sides of the marketplace. It's just one side is going to make more than the other. So you have to understand where you are in the marketplace, and you typically want to be where the side makes the most money. So bias is rooted around structure and order flow. Order flow is if price came down into this bullish fair value gap, found support. Bullish fair value gap, found a support. Wouldn't you think if it came down again in a bullish fair value gap, wouldn't you think it wouldn't find support again? You know what I mean? Like, that's order flow. The market is going higher, it should show support to support levels. As the market is going lower, it should show resistance at resistance levels. That is order flow. And narrative is based on where are you in the structure. We just created a high here. This high just took out this high. I'm anticipating a pullback into a level of support. Wherever that level of support be, let's say it's an order block down here. It's a low order block down here. It comes all the way down into this order block. Now I'm anticipating that pullback there to then see a continuation higher. That's bias. That's the easiest way I can explain bias, you know. Don't overcomplicate, guys. Next, market correlation. Market correlation is if, let's say, GBP USD, which is the German pound, Britain pound against the US dollar, if GU is going higher, you should expect the dollar to be going lower as well. This is market correlation. If GU is going higher and the dollar is, let's say, just consolidating or not really wanting to move, you typically don't want to trade GU because it's gonna start messing around and start trading like this. It's gonna be a lot harder to trade when the market's correlated to is not showing respect. So when you have a bias of it coming down into a support level, finding support to then see a push higher, you want to see the correlated market push lower, find a level of resistance, and push lower as well. This is what you want to see here. That's market correlation. There's also closely correlated markets, which are the index markets, preferably the ES or the S&P 500. So this is the S&P 500. If the S&P 500 is going higher here, it means the Nasdaq is also going higher and the Dow Jones is also going higher. If the Nasdaq chooses to go lower but the Dow Jones goes higher, the S&P 500 kind of just consolidates here. These are closely correlated markets. The Nasdaq US 30 are correlated to the S&P 500. So if they're in opposition of each other, the S&P 500s simply consolidates and it becomes a lot harder to trade. So when you are trading closely correlated markets like these, if the S&P 500 is going higher, you'd want to see signatures from the Nasdaq and the Dow Jones of it also wanting to go higher. This is where you can get the best moves. If you're seeing the Nasdaq go lower, you'd also want to see signatures from the dollar going higher. Or if the US 30 is going higher, you'd want to see signatures from the dollar going lower. These are correlated markets as well. So overall, we have a bias here, right? We're coming into a market, we've seen a push higher. We have a bullish fair value gap here. We know the trend has been higher, right? We're anticipating a pullback to go down here to then see a push higher, right? We're also looking at correlated markets as well, like the dollar. Seeing the dollar make a break lower. Dollar has a bearish, let's say, breaker here. Dollar has a bearish breaker here. It's coming into it. We want to see as the S&P or GU or whatever your market trades, as it's coming down to this level and finding support, you also want to see the correlated market also come down, come up into it level and find resistance. This just gives added confluence. If you guys want to know more about intermarket analysis, I made a full video on it, video before this, so you guys have to watch that video if you guys want to learn more on market correlation and intermarket analysis, but that's a brief view. Next is breaker structure. Breaker structure is just simply, let's say we have this, we have something like this, right? We get a break like this. This is a breaker structure. A breaker structure. We have this swing low being broken higher. When we see a break of structure here, it means there was support found here, meaning this low now becomes a strong low, meaning support, meaning price came down here, find support, and then broke higher. And now the market is shifting from lower prices, broke structure upside, to now higher prices. The market is shifting. So when we have a break of structure, we're anticipating a pullback. And that brings us into our last one, which is a fair value gap. So inside of this impulse leg here, more often than not, you will have a fair value gap, simply because a fair value gap is an imbalance. When you have a strong push lower or a strong push higher, more often than not, there will be a fair value gap in there, because a fair value gap is an imbalance. When price push higher and higher and higher here, all there was here was buying. And if we know the market loves fair value, meaning if there's buyers, there has to be a counterparty to those buyers equated to sellers. This is how the market operates. The market operates in finding fair value. So if we have an impulse leg here where it goes higher, market is going to want to come back down into that impulse leg, because it left an inefficiency of sellers and an imbalance of buyers, meaning the market just bought higher. There was no selling as price went higher, so the market is going to want to come back down to offer those sellers a position, and that's a fair value gap. So whenever you see a big impulse leg up like this, more often than not, there will be a fair value gap in it. And something like this, where you can take a long here and then see a continuation higher. Same thing here, more often than not. And this big swing lower, it left an inefficiency of buyers and an imbalance of sellers, meaning as it came lower, it was just sellers. So it has to come back up to offer those buyers fair value. So there's a fair value gap. That's the name of it, fair value gap. So boom, comes back up here and then drops. So this fair value gap breaker structure is on the lower time frames, and the bias and market narrative is on the higher time frames, meaning on the higher time frames, you're anticipating a push higher back into a higher time frame key level to then see a continuation higher, right? Inside of this level here of the higher time frame, there's a lower time frame pullback here for that continuation. You see that? Price came up higher, came down into this support level on the higher time frame, push higher, came down, gave another retracement on the lower time frames here. Your move to pan out. So when price action comes down into your support level aligned with your bias, so our bias was higher prices after price gave a retracement, this is what we want to see on the lower time frames here. This is what we want to see on the lower time frames, followed by market correlation, meaning if we want to see higher prices, we want to see the correlated markets push lower as well. Or if you're trading something like the ES, you want to see their correlated markets push higher as well. And I'm going to get into some examples of this, but this is essentially the 4 checklists that I look for when placing a trade that can pass any funded account. First example here is S&P 500. S&P 500. So we can see, let's go on to daily here. We have this area of targeting that we were targeting for the week, which was this first standard deviation. So if we put the fib from low to high here and put standard deviations on, this first standard deviation was an area of targeting for the week. So coming into the lower time frames here, price came up into that standard deviation and we were expecting a rejection, and then price rejected from it. So that's bias and narrative. Price came up into our resistance level and gave a rejection. Boom. Now, correlation. NASDAQ. The S&P 500 is connected to the NASDAQ and the Dow Jones, meaning if we want to see lower S&P 500, we have to see lower NASDAQ and lower Dow Jones. Do we get that? This is the Dow Jones and this is the NASDAQ. As you can see, the NASDAQ. Yes, we do. NASDAQ is pushing lower and lower prices. Dow Jones pushing lower and lower prices. We have bias, we have narrative, and now we have correlation. Now, we want to see a breaker structure. We got a breaker structure around this level here, and we did get a pullback into this inversion fair value gap. So there's 2 fair value gaps. There's your regular fair value gap, which you've seen textbook of, and then you have an inversion fair value gap, which is a bullish fair value gap turn resistance, or a bearish fair value gap, turn support. So those are inversion fair value gaps. But I'm not going to go over this setup in particular because this is not the trade that I took. I could easily show you this backtest example and be like, oh, this is where I got in, but this is not the trade that I took. During the live markets, at the time of price pulling back, I anticipated it coming up here and I didn't see this inversion. So I did miss out on this opportunity. Price pulled back here, but it didn't really pull back into anything, so we missed out on this opportunity as well. And it wasn't until it got to down here, this fair value gap. So we can already see the narrative coming up into this first standard deviation and seeing that rejection. We got the narrative. We have the correlation. NASDAQ is going lower. Dow Jones is going lower. We got the correlation down. We got the breaker structure. And now we have the fair value gap. So what I do, put a limit order right here at the fair value gap near the opening. Stop loss just above here. Just get a 2.5R. And price came up, tagged us in, and came down into our targets, just like so. Easy, bread and butter, very, very good. Next, I'm going to go over a GBP USD trade here to show correlation between the dollar. So what do we have here? So narrative. Coming into the market opening here, we see that we've swept liquidity. After sweeping liquidity, we see a break lower. Okay. So narrative is we swept this buy side liquidity. We see a break lower. What's the next area of targeting? The opposing sell side liquidity. So that's our narrative. Our narrative is we swept buy side. We're anticipating a pullback to then sweep sell side. No, the market goes from liquidity to liquidity and efficiency to inefficiency. So boom, we have our narrative. Now correlation. So since we see GU break lower, we want to see the dollar find support and break higher. And what do we see here? The dollar found support inside of this daily inversion fair value gap. So this daily support level dollar came down into, found support at, and is reversing. So we're seeing that the dollar is reversing here. So we have correlation here. The dollar is pushing higher and higher prices after finding support. We have bias, we have narrative for the dollar of going higher, meaning that we'd want to see the GBP pairs go lower. So we have correlation. Dollar is going lower in accordance to GBP USD going higher. Now, break a structure. Break a structure here. As you can see, price was going higher, higher, higher. Strong break lower. Broke structure. This high now becomes a strong high. We don't want to see price come back up into this high. So any inefficiencies or imbalance we see in this leg, we're anticipating a pullback to see a continuation lower. And what do we see here? See a fair value gap. Boom. When dealing with larger fair value gaps, take out your Fibonacci tool and go on quadrants. These are some of my key levels: 0, 1, 0.5, 0.25, and 0.75. So the 25% level, 0.50 level, and 0.75 level. So when trading fair value gaps or bigger fair value gaps between the 0 and 25% level. So in this instance, I'll put it at the 25% level. Stop loss just above here, or maybe up here, and take profit down here for about 3R. It's not bad. Not bad. If you want to be more preservative, I guess you could put your stop loss up here just to be safe, but you'd get it like a 2R. But if you want to be a little more risky, yeah, 3R. And let's see how it goes. So we have the narrative, swept liquidity, boom. Dollar is going higher. We have the correlation. We have the drawn liquidity, which is our narrative. Drawn liquidity here after just sweeping out liquidity, boom. We got the breaker structure. Now we got the fair value gap. We can put a limit order, or you can wait until price come into this fair value gap, whatever you like. And then price eventually taps into our trade. Plays around for a bit, but it eventually gets down into our targeting for 1 to 3R. Super, super solid. So that's going to be it for the video, guys. I hope you guys learned something from this. Make sure you guys leave a like, subscribe, share this to someone who may need it, all of that jazz. And I'm Arkham. Be safe.